Good morning, everyone. I am Nataraja Upadhya. This is my attempt to learn the investment universe better by forcing myself to teach. That way, my learning happens.
That's
So,
great.
this is the second session. The series is titled as Fundamental and Technical Analysis for Idiots. Idiots meaning the beginners or dummies. The level of humility is required for learning. So that term is deliberately chosen. The second session is going to be the world of mutual funds and ETFs, because this is an easy way of investing for a beginner. So this is an important session. So I thought I will get this going. So I'm using a PowerPoint. I have included the session invite for the late joiners. So today's agenda, 5 minutes of introduction and context and background, 20 minutes of basics of mutual funds and understanding the ETFs also for 5 minutes. Then we discuss the Indian mutual fund and ETF universe, the choices we have for us to invest. Then I have been releasing the weekly blog providing the ranking of mutual funds based on 1 month return. So I would walk through such a blog, most recent blog, that may take 15 minutes. Then we may be left with 15 more minutes for the question and answer. So while I'm talking, if you need my attention, try to send a message through the chat and I will try to look into it. So now coming to the introduction, this is kind of a repetition. Basically, there is a community level activism around me. I am more like a cheerleader here. So peer level investment and trading community. So I actually have different types of communities depending on the different type of networks I am associated with. The one that is main is the one where I leave daily remarks as part of my day trading. So that link can be given later in the chat section. The idea is to have an accelerated learning so that this learning happens by different people providing these kind of sessions. Before asking others to give a session, I needed to lead by example. So I'm trying to conduct sessions where I feel comfortable as I am learning. So actually, every one of you are invited to participate as a speaker. And if you are volunteering, there are so many topics to talk about. So please come forward and please contact me in this regard. So there is a need of balancing our learning, improving our maturity, improving our resource investments, and improving the efficiency of wealth building. All this is going in parallel. I understand that different people in the community will be in the different pace, but we can help each other. And idea is to have fun of learning, fun of making money, and fun of interacting. So, so it is a long journey. There is no shortcut. We have to learn and get a mastery on the subject to do well. So there are no silver bullets here. The focus is learning and maturity. So journey is very important. Of course, we should aim high, like success like Rakesh Junjunwala. We can achieve it with the smart work, hard work, and time and consistent journey through a path. So that you know that that is the inspirational aspect. So we may be a bit rough and clueless to start with, but as we go, this group and these sessions will become more matured and better in class. So there will be some transformations with the learning uh, and adaptation of the techniques. Some of them are linear, some of them are non-linear, but at any given day you would have a feeling of half glass empty and half glass full, and that is a good feeling to have, because that is what the reality is. The investing universe or the reality is always like that. you have an opportunity for reward and opportunity for risk, which is to lose money. So we need to look for those escape velocity, like to send a rocket on the to the sky, we need to achieve certain escape velocity. Here also we need to achieve certain escape velocity of learning and maturity and analysis, synthesis, technique, and artistry. So that sense, as you get, you become better in investing. So because we are part of the community, there are multiple roles to play: student, teacher, mentor, activist, cheerleader, companion, and a friend. So do not hesitate to play multiple roles so that we all will benefit better together. So today is the second one, and there will be many more that will be coming, and we'll define as we go. And much later, I definitely see a need for portfolio management, which talks about diversity, risk management, and reward optimization. So that thing will come up soon, more as an intermediate subject, if not advanced. And I would like help to get into sectoral research, model the sectoral linkages, the value chains. So I do need volunteers there. And later we will discuss different types of investment and trading styles, again contributed by different persons in the community. So with that background, now I am moving into the next session, which is the mutual fund basics. See, mutual fund is a very simple concept. It's a collective investment vehicle. So basically, they pool money from various investors. Then, depending on the type of the fund, it can go to a set of equities or bonds or government securities or money market instruments, or even commodities like gold or silver. And you can have hundreds of types of mutual funds, depending on some of them are purely equities versus a mix, and the style of investment, etc. So that we'll be seeing soon. So the key difference is that the mutual fund is managed by professional money managers, and they are better than us. So they know what they are doing compared to much better when compared to us. Therefore, there is a very good chance that you would make better money as a beginner by investing in mutual fund than trying to do it yourself and not knowing every aspect of risks and reward situation. You may underperform. Therefore, as a beginner, one should always consider mutual fund as an important investment vehicle. And even I would say that one should allocate more than 50% of the investment amount in mutual funds, and use very small amount as a play money for your own investment and trading, only to prove, or until you prove that your returns are much better than the mutual fund return benchmarks. And what are those mutual fund return benchmarks for Indian reality, we are going to discuss later. See, mutual funds, these are broad types. There are further types we will discuss later. See, mutual funds that invest on equities or the equity scripts can be called equity funds. Now, there are various index funds or exchange traded funds like Nifty or NSE or BSE provide you various funds like Nifty or Sensex. Then there are various other subtypes also. One can invest in these indices through an ETF based mutual funds. Okay. Then there can be fund of funds. That is, there could be a fund of fund which collects money from investors, then allocates how much money goes to which different constituent fund. So that also can be considered if you are especially happy with a particular fund house like ICICI Prudential Securities or Quant Fund House, etc. Then there are various funds based on certain thematic funds. This could be sectoral, or specific, target, investment target like pensions or savings, and also different investment styles also will come. We will discuss this in detail as we go. So in contrast to equity funds, we can have debt funds. Obviously, debt funds are based on debt instruments, which can be money market funds or liquid funds, which are debt and money market combined, gilt funds, which are basically government securities based funds, and there can be fixed maturity plans, which means they will expire on a particular day, So debt funds always carry an interest rate. So what happens is when the interest rates go up, the debt instrument value reduces, and it happens vice versa, which is when the interest rates are reduced, the value of the debt fund goes up. So debt funds have various debt instruments, and each debt instrument has two parts: what kind of interest it collects and what kind of face value it has. So one can make money in debt funds or lose money in debt funds based on the face value, which varies based on the interest rate. And certain debt funds, while may have an interest rate, you can have something like zero coupon where there is no interest you are going to collect. So we will discuss that further. Hybrid funds are various mix of equity funds and debt funds. Therefore, in a bull market, equity funds give very good return, and in a bear market, debt funds can become attractive than equity funds, and a hybrid funds can be a bridge between a bullish and a bearish situation, and hybrid funds can be very well invested in equity versus debt. So there is a range. So aggressively equity versus aggressively debt. You can see various types later. Then commodity funds, which are very attractive in India nowadays, are the typically gold and silver funds, is what I have seen so far. So when you talk about mutual funds, your focus is either growth or income or exploiting the value. Let's say when there is a bearish phase, lot of scripts will lose their valuation, sometimes even below their book value. Then a fund can leverage such a situation through a value fund, basically collecting various undervalued scripts and thereby giving you better returns as the bull phase returns. So value funds are more popular at the end of bearish phase of the market. One important fund is tax saving funds. These tax saving funds provide you certain tax saving option on your payment as well as on your returns. If I remember correctly, I think it is a minimum 3 years commitment. So let us understand the key players involved in mutual funds. I'm going to go at a very high level. Please understand that a mutual fund is represented by an asset management company. For example, ICICI Prudential, AMC can be an example, or Quant AMC can be an example, HDFC AMC can be an example. Such a company is sponsored by a sponsor company like HDFC. Bank could be sponsoring HDFC AMC, or HDFC AMC script company may sponsor the asset management company. There will be this board of trustees to guide this asset management company. Then there are two players, which are important players: custodian versus registrar and transfer agent. the custodian is the one who actually maintains the securities so that the fraud does not happen by asset management company. There will be so much of check and balance, and the investors do not get into fraudulent situation. Registrar and transfer agents deal with the administration of the fund. We will revisit this. So I have given these definitions here. Fund has a fund manager, who makes investment and trading decisions. See, when you invest, when a fund manager makes investments, he also buys and sells on a regular basis. So there is a trading also involved. So the associated securities are parked with the custodian. Okay. Next point, registrar and transfer agents are also called RTAs. Their responsibility is just record maintenance. In India, the two very popular RTAs are Computer Age Management Service, CAMS, or CARVI. Okay. The next point is saying that a mutual fund custodian can be a trust company or a bank or a financial institution, etc. So I have not gone into examples. There are so many such companies are there. Next is each fund is associated with the fund accountant with accounting responsibilities, with the necessary auditing needs, etc. Therefore, an auditor also is appointed. This auditor can be an insider or an outsider to the AMC. Then there are intermediaries or distributors and brokers. These guys can be agents or bankers or distributors who help to get investors to a fund, to a mutual fund. Now, typically, an intermediary collects a commission for such investment. Therefore, an individual investor like us have an option to directly invest into a mutual fund or through an intermediary or a broker who will collect a commission for that. Therefore, a direct plans are much advantage for the individual investors when it compared to regular plans, which are through the intermediaries. However, the regular plans can come with additional free advice, etc. Then there are dealers who help the AMC to deal with the investment and trading, which happens in the background and not relevant to individual investors like us. So next slide. Okay, when we talk about mutual funds, we need to be aware of the linkage to key regulatory bodies. Most important one is AMFI, which is Association of Mutual Funds in India, acts as the registering or the licensing body for mutual fund distributors in India by virtue of the responsibility delegated by SEBI. Okay. A decade before, I also attempted to become a mutual fund distributor. So I was required to take a test and have a certification to do that. So AMFI provides such services also. Next one is SEBI. We all know about it. Securities and Exchange Board of India, similar to SEC in US. It's a regulatory body for securities and commodity markets. And this comes under Ministry of Finance at central government. And RBI also has a very important indirect role, which is it's a central bank. It's a regulatory body for all the banking system. It is owned by Ministry of Finance. It's responsible for monetary policy, issuing currency, managing foreign exchange, working as a bank for the government, and a banker of scheduled commercial banks. So so all these have indirect linkage to the markets, the exchanges, and the mutual fund universe. Moving to the next slide. We need to be aware of some key terms. A mutual fund, we have understood, is represented by a fund manager who is an investment expert, right? And has certain qualifications and has certain even track record. So certain people follow certain mutual funds based on the popularity of the fund manager, based on his or her success in the past. There is an annual fee involved with a mutual fund. It is called expense ratio. This is deducted from your investments on an annual basis, and this expense ratio is mentioned in the mutual fund prospectus, and that is a price you pay, and that is that it includes all the costs of mutual fund administration, the distribution fees, and even the profit the mutual fund AMC is going to do. So typically this can be anywhere between 0 to 2%. India doesn't have entry load, which is while entering the mutual fund, they used to collect a fee, which is now abolished. There can be an exit load, that is when you come out of the mutual fund, there can be a charge or a fee. Typically, these fees can be for special situations, like if you are coming out of the mutual fund within a stipulated period of 3 months or 1 year, so it is possible to have a mutual fund exit without an exit load also. So it varies. So be aware of what are the exit load implications in the mutual fund you do the investment. Next term is asset under management. Since all the investors give the money to the AMC, and these investments add up, the adding up investment is called assets under management. This typically runs into thousands of crores. Now, how do you ensure that there is a rationalization between the money that is coming in, money that is getting invested, and the money that is going out? So that is done by a mechanism called net asset value. That is, the mutual funds are represented by basic unit, and there is a price per unit, and this unit is represented by net asset value, and net asset value varies based on how the underlying investment goes up or down. Therefore, a new investor, when brings money, let's say 10,000 rupees, based on today's net asset value, let's say 40,000 rupees will give 25 units. So 10,000 is 250 units. And let's say that the investor stays with the mutual fund for an year, let's say with the 30% appreciation. Now the 250 units bought at 40 rupees at 30% appreciation will be at 52 rupees. So the payment will be 52 rupees into number of units, which is 250. So typically, this is the basis how the payment will be calculated when an exit happens. Of course, minus the charges that are applicable. Certain charges are applicable as they happen, like exit load on an annual basis, and then there can be some special charges also. For example, exit load, if the exit load is applicable. So net asset value is a mechanism of managing the mutual fund investments between incoming and outgoing, payment obligations. Otherwise, you don't need to worry about it. It's more of an accounting basic. But you need to understand what is NAV more to appreciate the investment appreciation rather. Next one is lock-in period or a maturity date. Certain mutual funds would have a commitment as to how long the investment needs to be in place. In other words, there will be restriction as to when the mutual fund can be withdrawn. This can be for certain tax saving funds. It could be certain debt funds also. There could be certain penalties applicable if there is a flexibility on the lock-in period negotiation. Typically, mutual fund investors go for systemic investment plan. This is something very easy to understand. We already discussed net asset value. So in a bullish phase, as the underlying stocks appreciate, the net asset value goes up. So there is a number of units one can purchase for the payment made or the investment made based on the net asset value. Now, if the market corrects through a short term, then the net asset value of the mutual fund reduces. So the concept here is averaging between bullish and bearish phase of the market. By committing to pay a standard amount on a periodic basis, you can get more number of units through the bearish period and less number of units through the bullish period, which balance out and give you average return that which is much more superior than trying to invest one time in a bullish phase, which gets eroded in value through the bearish phase, and your returns can be substandard. Therefore, people who are not aware of the market dynamics are recommended to go with an immediate approach, which is averaging it out. Now, certain smart people have worked out certain variation of systemic investment plan, which is instead of continuing to invest through the bearish phase in standard intervals, one can simply wait for the bearish phase to be over, then invest double the regular payment. So these kind of techniques are available. It is up to the individual. Systemic investment plan usually assumes an interval of payment. So instead of SIP, you can go for bullet payments whenever you want to pay. In which case you will use those techniques as I mentioned. So SIP is just to set a regular payment plan and not worrying about what the market is doing, because you have faith that the fund will give reasonable return over a period of time, irrespective of how the market behaves, because the fund managers will do the job. But there is no guarantee that all fund managers do the job properly, because when you look at mutual fund returns, there are certain mutual funds which have given negative annual returns. So you need to be aware and beware of how your money invested is performing. Similar to SIP, there can be systemic withdrawal plan, SWP. When you withdraw funds, there is a tax liability. In India, currently short-term returns, short-term are at 15% tax, and long-term returns are taxed at 10%. Therefore, depending on how you have invested the funds at what intervals, you may want to have a discipline of withdrawing systemically. Let's say, for example, you have all your funds in money invested in mutual funds, and let's say you are sitting on a 2 crores of investment, but you are in a retirement and probably you need something like 10 lakhs per year for your expenses. So you need to have a systemic withdrawal plan that adds up to 10 lakhs. And hopefully your 2 crores investment is appreciating at 30%, which is, it's adding 60 lakhs, but you are withdrawing only what you need to spend, which is 10 lakhs per annum. So these kind of flexibilities can be accommodated in your mutual fund investments. Now the asset allocation, the mutual fund the fund manager does the asset allocation based on various strategies or styles which are published or dynamically applicable based on market conditions and variations. So that is more internal to the fund manager, but those approaches are published and you can be aware of it before or during the investment. So we already talked about asset management company. Now the turnover rate. Turnover rate is typically how the mutual fund investments are churned with the hope of better returns or a better risk management, So that gives the indication of how much activity is involved in the fund. The KYC, know your customer. This KYC is a mandate required in India that prior to investing in mutual funds, you need to have a KYC compliance. There are standard processes for that. And it's my understanding that one needs to have a demat account because the mutual fund units, what you have bought, they typically get parked in this demat account. So they are safe for you. One does not need a trading account. Demat account is enough. So the linkage between your bank account and the demat account works very well. Nowadays, many banks, while they provide you the phone-based app, they also provide you the demat services. So you can do mutual fund investments directly from the bank. However, be aware that there is a difference of investing directly or through an intermediary. If you want to save the additional fees applicable through the intermediaries, you would consider the intermediaries who do not charge such fees. So that consideration is applicable, though it could be a nominal 1% difference usually. So when you do the mutual funds returns analysis, always you get two values, one for direct plan and one for regular plan. Next, bull market and bear market. We understand this. There are business cycles at overall macroeconomy as well as various sectors. So as a result, because of various factors like macroeconomy, political situation, ecological situation, technology advances, and many other considerations, the markets tend to keep going up or going down. When they keep going up, it's called bull market, and when they go down, it is bear market. Again, it is a long-term bull market versus long-term bear market. Then there can be short-term bull market and short-term bear market. So the short-term corrections are linked with the bear market, and appreciations are linked with bull market. Then there are some blue chip stocks. Basically, blue chip stocks are typically, large cap stocks. What is a large cap? I will come to that later. And they're typically with good management and track record. And these blue chip stocks are typically represented by an index like Nifty 50 or Sensex 30. So it is possible for some people to just track the investment in blue chip stocks with certain mutual funds. The capital gain is the appreciation you get based on your investments, which can be short term or a long term. Anything above 1 year is long term. The taxation implications will be there. What is a new fund offer? the new mutual funds take off based on various themes and investment uh, objective styles, etc. So when they take off, initially they collect money and then they make the investment. This takes some period, say 2 weeks, 3 weeks. So typically in an established mutual fund, when you make an investment, immediately you will get a allocation of the units based on the governing net asset value. What happens in new fund offer is they're just collecting money with no clarity of net asset value. Then they decide where to invest how much, based on which they will come up with the baseline NAV. That's what happens in new fund offer. Now, there are two aspects here. If the mutual fund is managed by a reputed fund house with a reputed fund manager, the investors are eager to put money with the hope that there will be good return from the day one itself. Now, the fund manager also has an advantage because he or she has a clean slate and lot of money, and depending on the market dynamics and vagaries, he or she can decide which vehicle will give the best return. So when you contrast this with an ongoing mutual fund, what you have already invested is something that will hold you back. So this can be an advantage. So many times new fund offer is considered advantageous if it is by a reputed fund house and a fund manager. It can also turn not an advantage if it is not done well. So you have to take your call. Then open-ended and closed-end funds. Many mutual funds are closed-ended, meaning you cannot invest new money into it. Open-ended funds, you can keep on adding new investment money. This coupon rate is basically an interest rate associated with a debt instrument, which is applicable for a debt fund or a hybrid fund, which has a debt component. A zero coupon rate is basically a debt instrument which does not carry any interest at all. Still, one is interested to trade that based on variable interest rates, especially in hope of interest rate going down in near future. We already talked about direct plan and regular plan. I always go for a direct plan as much as possible, or a regular plan where there is no fee involved. I typically use Zero the coin, but there are many other options also, which I will discuss later. So when you invest in an established mutual fund, you have a choice of growth plan or a dividend plan. In dividend plan, mutual funds give dividend to the investors based on the number of units and the dividend percentage they decide. Now, this dividend can come regularly, let's say every quarter or every month or every year, depending on how the fund house is planning it. Whereas in growth plan, whatever that dividend is, you can ask them to reinvest. Now, dividend plan was very popular in those days when dividend did not attract any taxes. Nowadays, dividends do attract taxes both at the distribution side and the collection side. So dividend plan has become less popular. However, depending on your financial planning, you may want to go for aggressive investment into mutual fund with the confidence that you are getting some amount of dividend on a regular basis, which may be say 1 to 3%, but that is more than enough to cover your expenses. Then you may have a reason to go for a dividend plan also. We talked about custodian. Indexation is again a topic that is applicable in India for interest-based investments because of the because of the, what is the word I am looking for? Inflation, money value keeps going down. So government tries to help the investor by a concept called indexation, where year on year a corrective measure is given, so that your prior investment is worth more than what its face value, because of the accumulated index of inflation. This was useful for debt funds, but I heard that this provision is now removed. So indexation is less applicable now. Now let us talk about mutual investment channels bit more detail. Direct plan is something you can buy mutual fund with no intermediary. So there are some investor service centers, that are available, like camps or Carvi. Registrar and investor service centers are offline centers that are made available. Registrar and transfer agent is what is Carvi or camps. They have their own offices, or you can simply do online with these agencies, or directly with the fund house. Such websites you can directly go and apply. Typically they will ask for KYC and all that, but it gets done very smoothly nowadays. Next one is regular plan, where you go through a broker or a distributor agent. In my case, I go through Zerodha. So it is a regular plan, but though it is a regular plan, Zerodha gives me an advantage by not having any fee. So typically Zerodha Coin, Upstocks, Fires, Pro Stocks, India Bulls, Paytm Money, they offer such services with no additional overhead. I'm not sure whether Angel also gives such service. I'm unable to verify that. Irrespective of whether there is a fee at investment time, mutual fund distributors do get quarterly trailing commissions based on the assets they have influenced. Such commissions are built into the expense ratio. So there is always a difference of expense ratio between direct plan and regular plan. So people who would like to squeeze as much cost as possible usually choose direct plan. People for convenience and some free advice, etc., will go for regular plan. So let's move to understand the terms associated with capitalization. See, market capitalization of a stock or a company is number of outstanding shares into price per share. So as the price per share changes, day in and day out, market capitalization varies. Since there are so many companies with different sizes of market capitalization, a grouping has been done into micro cap, small cap, mid cap, and large cap. A micro cap company is with a capitalization less than or up to 500 crores. A small cap is usually 500 to 7,000 crores. Mid cap is 7,000 to 20,000 crores. And large cap is above 20,000 crores. Therefore, when you hear mutual fund categories like micro cap, small cap, mid cap, large cap, or mid cap and large cap combined, you understand what are the type of companies they are going based on the capitalization. Though there is a crisp definition, what happens is the stock price doesn't stay, and especially if there is a bullish phase, stock price can double or it can become half. That means within a matter of 1 to 3 months, a mid cap company can become a large cap, or a small cap company can become a mid cap, and a large cap company can lose its capitalization and reduce to a mid cap company. Therefore, in the industry, when they talk about a certain company associated with certain capitalization type, there is a level of confusion, because these stock prices do not stay stable. So take it with a pinch of salt, and be aware that when someone is talking about a mid cap company, it can be actually a large cap company today, and vice versa. So now let us discuss about various fund types. Let's start with the equity fund. See, equity funds are most popular because they offer maximum return for a country like India, which has a GDP growing at a rate faster than rest of the world. Therefore, the stock market returns are much higher through the equity funds. So the popularity of the investment is highest in the equity funds. Um, I think out of 1,600 plus mutual funds India has, 800 plus are equity funds. So at least 50%. Now, when you look at the equity funds, certain funds are BSE based, which we'll discuss in detail later. Certain funds are focusing on giving you best dividend yield, which is again linked to your income requirements. You can have dividend payment option, then enjoy your income. Diversified equity means it goes across different types of capitalization or different types of sectors. There is no restriction. ELSS tax saver is primarily for tax saving purpose. I was told that there may be some issues which I had to validate, that the tax regime is now changed from old to new. So these itemized tax saving may become difficult for some people. So in such cases, they may not benefit from ELSS tax saver. I have to verify that, and because I'm paying taxes after a long time for the first time, so I will learn it through my experience by June. Equity income, basically, equity is focused on generating income, which which kind of overlaps with the dividend yield, or it can be an equity plus some amount of debt also. So some kind of overlaps will be there in the usage of terminology. So just be aware, just understand the concept. Ethical funds, certain ethical funds are there mainly because the investors, uh, can you just hold on? I have some, okay, that's fine. I can continue. So investors have certain consideration, ethical factors related to governance or ecological factors or religious factors. For tailor made to such investors, certain ethical funds are there. Typically these funds underperform because of these restrictions, but the investor is happy that he or she is doing the right thing by going for ethical investments. Taurus ethical fund is what I have seen so far, which has popped into top 50 category once in a while. Flexi cap. Flexi cap is free to invest in any market cap. Large and mid cap combinations are there. Mid cap we understand. Multi cap and flexi cap. The difference is, in case of multi cap, minimum 25% allocation is required across large cap, mid cap, and small cap. That restriction is there. Whereas flexi cap, it's a it's a total freedom for the fund manager. Nifty based funds, we'll see the detail. Quant fund, which is quantitative investing, which can be linked to that automated investments also. Quantamental fund is a mixture of quantitative investing and some fundamental investment in investing. It's just a big word. Value fund, which is basically value investing strategy. Then there are boatloads of thematic funds, which we'll see further. Coming to BSE based funds, since BSE has various indices, you can have various variations of these indices, like S&P BSE 100 ETF, S&P BSE Enhanced Value ETF. And what is enhanced value? Measure the performance of the 30 companies in the S&P BSE large mid cap. So those kind of specific considerations are there. Then there is a difference of S&P BSE Enhanced Value ETF and S&P BSE Enhanced Value Index. What is the difference between the ETF and index is more in terms of how the investment is done. In case of index, investment is done at the end of the day at that prices, whereas ETF can be real time as it happens. So it's a marginal difference. It's just a flexibility. So using this example, I wanted to highlight the difference between ETF and index when the mutual fund has almost same name except for ETF and index. So be aware of that. Then BSE Housing Index, Sensex Next 50, BSE Low Volatility Index Fund, various things like that. I am not keen on this. I'll tell you why later, but it may be relevant for various people. Now, Nifty has far more variations. Nifty basically NSE. So it's not only Nifty based funds. There are various ones. I will not get into discussions for the time. Now the thematic also, just read through it. So many themes. Themes could be sector based like banking and financial. It could be a particular investment vehicle like Bal Bhavishya Yojana, or it could be some other. I forgot to find out what is comma fund. It could be an investment that is targeting the foreign stock market like Nasdaq 350 or Nasdaq 100 or NICE exchange, FANG plus ETF. The FANG are the most popular stocks which have majority of the capitalization of the US market. Like that you have for Hang Seng, you have Taiwan, you have Japan. I actually wanted to invest in Japan, but I found out it is not allowed for individual investors, only for institutional investors, because Japan has gone through a recovery. Therefore, it will do well in the next 1 year. So I am in the lookout if there is a way I can participate in the Japan market through mutual fund. My problem, don't worry. Similarly, hybrid funds also, there are various variations, depending on whether it is conservative on debt side or conservative on the on the equity side. So I was keen to understand what is an absolute fund, because it's a big word. It seeks to provide long-term capital appreciation and current income with a mix of fixed income securities and equity instruments. So basically, there is a balance between long-term capital appreciation and current income. Both are required. So it's called. So it was not intuitive name for me. So I just similarly arbitrage fund, hybrid funds that invest some of their assets in debt. These investments, however, are typically in term deposits or very short-term debt. Again, I'm not very impressed with the term. It's not intuitive, but this is useful. Balanced advantage fund means equity is above 65%. Balanced hybrid fund is equity less than 65%. Similarly, there is a multi-asset allocation. You can have equity, debt and commodity all mixed up. That can be dynamically managed also, dynamic asset allocation. Typically, insurance companies provide unit-linked insurance, and typically they provide, in a hybrid fund manner, so that you can decide how much equity, how much, debt percentages. So such funds also appear under hybrid funds. Then investment vehicle for retirement or children, all that will be available, both in equity as well as in hybrid funds. Debt funds are mostly invested by high net worth individuals or institutional investors. The retail investor is more happy with the bank FD, fixed deposit, than a debt fund. So we don't need to discuss much. I personally do not get into debt fund, because if at all I would consider a hybrid fund. I am more attracted to next type, which is called commodity funds, which is gold and silver. and off late commodity funds are doing very well. So I have been investing a bit. So that is kind of basic environment of mutual funds. I hope you got a sense of it. Now let's understand ETF, which is exchange traded funds. There is a overlap between an ETF and a mutual fund. Let's try to understand that. So exchange traded funds combine the flexibility of stocks and the portfolio diversification strengths. eh? Basically, it's an affordable way to access a wide variety of asset classes. For example, let's say I want to invest in a Nifty index. See, Nifty typically gives 15% year on year on an over a period. So I am happy with 15%. I just want to invest in Nifty. So in such case, I can go for an exchange traded fund based on Nifty 50. Now, an exchange traded fund of Nifty 50, it can be available as a script, in which case you can buy it as a script, buy and sell like any stock. Or it can be available as a mutual fund, in which case you make an investment like any other mutual fund with some overheads. Both will have overheads, but uh, an ETF as a script has a very low overhead because they will automate the investments based on the Nifty percentages of various scripts associated. So it is kind of a passive fund, whereas a mutual fund is bit more active, so it may have higher percentage. Therefore, when you see a mutual fund on a in index, it may have slightly lesser return than an ETF script. So that distinction I wanted to highlight for you. So typically ETFs you can buy and sell as a script in the exchanges, whereas an exchange traded fund based on an index, which is available as a mutual fund, typically gets normalized on its buy and sell once a day at the end of the day. That distinction is all what you have to remember. Now, various ETFs are there. It could be index based, it's fixed income based, it could be commodity based, it could be leverage based, which is if the stock value moves one time, your ETF value can move 2 times or 5 times, and vice versa. So this could be quite risky game, but such leveraged instruments are available. It could be actively managed or passively managed. I discussed that. Exchange traded notes, ETNs, are more relevant in debt market. We'll skip that. Specific strategy based ETFs are there, which we saw in various examples. Specific style can be there, like small cap versus mid cap, or micro cap.
You're on mute. You're on mute.
Okay. Hello, everybody. I'm back. There was some disruption, so would like to continue. Okay. Let me make sure I have the right slide to continue. Okay. So I'm ready to continue. So I'm going to mute whoever is not required to be unmuted. Okay. Okay. So let me continue. So the foreign access to foreign markets is a flexibility we do have through mutual funds. So that's all I would like to say. So having covered ETFs, now I'm moving to Indian mutual fund universe in terms of nuts and bolts, so that we do have a sense of what it is. So let me take the a portion of this week's analysis report. Let me go through each line so that we can appreciate what is happening in India right now. The first line, top 50 funds average based on 1 month return. Remember, we are going through a correction phase. This each column is basically 1 week versus 1 month versus 3 months versus 6 months versus 1 year. So keep that in mind. So the first line shows an annual return of 10.37 for the top 50 funds based on 1 month return. This is because of the ongoing correction. The most of the well-performing funds in the last 1 month are belonging to commodity funds. That's why you see a very subdued return. While these commodity funds have given you 1 month return of 7.83, their other returns for 6 months and 1 year are not very attractive. So that tells you what is going on in the market also by looking at these averages. Let's go to the next line, which is bottom 50 funds. See, there are total 1,563 funds in the list of value research data. I have taken the bottom 50 funds, covering all types. If you notice, the 1 year return of them is 40.16%. This is because all the equity funds that did very well until recently now have given negative return, which is minus 5.09 over last 1 month. However, their accumulated appreciation is so much. Even after correction, they are sitting on 40.16% of annual return. That is what. So that tells you that all equity funds have gone, high performing equity funds have gone to the bottom 50, is what it tells you. Top 50 funds average based on 1 year return. Instead of 1 month, if I go for top 50 funds based on 1 year return, average return of top 50 is 74.52, which is very impressive. 6 months return is 32.28 and 3 months return is 12.68. And all this is after the correction. Okay. And here you will see that even last 1 week return is 2.72, which means the correction seems to be getting done, right? But we need further validations through next 2-3 weeks. Fourth line, bottom 50 funds average based on 1 year return. If you notice, across all fund types, the return is 1.89. Okay, that means if you are not being careful as to which fund you are going to select, you may end up with very substandard returns, is the message here. The last line, which is all funds average based on 1 month return across all 1563 funds. Mind it that only 50% of this 1563 are equity funds. Even then, the total return annually is 27.67. So what I am trying to say here is that your portfolio return should be at least above this for the last 1 year. Let's go to the next segment of the table. Here we are discussing about only equity funds. There are 817 funds. First line is 1 month return based on top 50 of 1 month return. Second one is top 50 of 1 year return. And the third line is average of all 817 funds across different timelines. The first line, you can see that first line is top 50 equity funds gave a 4.89% return through the month and 1.82% return for the week. So again, you could say that while certain equity funds are still correcting, there are some better performing funds which gave 4.89%, which are basically large cap stocks, I know. So by making a shift in your equity fund strategy, you can continue to have appreciation is the message here. Second line is 1 year return, which is already discussed, and all equity funds average, if you notice, is 42.26, which is much better compared to all fund types average, which is 27.67. That is, if you are doing investment only in mutual funds, there is a very good chance that you should aim for this 42.26% for the current market dynamics. So that tells you how well you should be doing in your mutual fund portfolio. Similarly, I have for hybrid funds and debt funds and commodity funds. So I will discuss hybrid funds in bit in detail. If you notice, based on top 50 1 month, it is 29.64 annual return. Top 50 based on 1 year return, it is 34.64, and all hybrid funds average annual return is 22.34. So as an individual, our investment portfolio, depending on whether it is 100% equity or X% equity and some in hybrid, I would say there is a range of 22.34 all the way to 74.52. So somewhere in between means it is possible that many of you have hit 50% annual return at a portfolio level. And if it is done, congratulations. If it is not done, please review what else can be done. I am skipping debt funds because they are managed comparable to bank interest rates. Right now, I am skipping that. And if you are already in debt fund, you are smart enough to know what to do with it. So let's go to understand another scenario here, which is equity mutual fund returns for the last 11 years. Because I got this data from Value Research. So I have plotted it here. If you notice that first row, equity, the top performing fund for every year, this year it was 101.72, and the least in that was in 2015, 28.73%. Okay. Top 50 funds average based on annual return. If you notice, this year it was 74.52, much better than last year for 56.66. So we had a better year this year when it comes to equity funds. Congratulations. If you just take all equity funds average, because maybe you did not get to pick top 50 funds for whatever reason, you just happen to be an average, having an average portfolio. Even here, if you notice, this year, average of 817 funds return was 42.626%, way ahead of 31.13% last year. So again, if you didn't achieve this kind of return, you need to wonder what needs to be done in your portfolio. Now, let us contrast this with Nifty 50 return. This year, this financial year, Nifty 50 returned 28.6%, whereas last financial year, it gave only minus 0.6%. So you can see that mutual fund, equity mutual funds can do really well, even against nifty returns. This is because it is managed by the professional fund managers. That proof is here. So, just to illustrate that, I have put this table together. Any further discussion we can deal in question and answer. Now, when you look at choices you have for the fund investments, there are so many fund houses, with the different degree of reputation and choices and flexibility. There you can look at the last point. What I have put is, for some reason, I am yet to figure it out. CPSE and Bharat 222 are actually ETFs. They are not really mutual funds, but they are included in the value research data. For example, CPSE is the top performing fund as mentioned by value research, which is 101.72%. Actually, it had hit even 110% because of the recent correction. It has come down to 101. Even then, it is very impressive. But if you want to invest in CPSE, you should buy this CPSE as a script in NSE or BSE. So keep that. So to give that distinction, I have mentioned separately. For some reason, value research has included CPSE and Bharat 22 ETFs as if they are also mutual funds. So but CPSE is something to be considered, because last year, which is financial year 2023 also, it was CPSE which gave 95.65%. In other words, if you had invested in CPSE 2 years back, I think you could have had 3 to 4 times return by now. And it is very sad if we have not done it. Got it? No? It's so good. So such opportunities are popping up in Indian mutual funds, where we don't need to have any, decent knowledge about stock market. So people who accept their status of being a beginner or being a dummy in stock market, or if I can even take the, liberty of calling idiot, you are having a very good chance of doing very well by accepting that you are an idiot. Therefore, I will count on a reputed or a proven fund manager and a fund. You can achieve these kind of returns in Indian market. And that is why this particular presentation is made, to impress upon you that you should not have any excuses against entering the mutual funds. It's just you need an approach and a discipline. To reconfirm that, I have included this. So next, Indian ETF universe. Here I am not going to talk much into detail, because basically you can invest in them as a script, so you can study them. There are websites, links I have given in the presentation I have sent. There are NSE India, BSE India, even MCX has some ETFs. Some of them are gateways to foreign investments. Please go through that and see whether you can invest in these ETFs in the spirit of mutual funds, except that these will sit as scripts in your demat account, and you will trade them through a trading account, whereas a pure play mutual funds can be done using without having to use a trading account. So that kind of brings to a conclusion for me. Please be in touch with the Value Research, Money Control, and AMFI and Mutual Fund House specific website for more information. If you guys want how to look at a mutual fund detail using Money Control, we can discuss it as part of question and answer. Now, before going to question and answers, I wanted to review the recent blog I have released yesterday night, or I can do it as part of question and answer. Only if there is an interest level, I can go into detail. My session is supposed to end by 12 o'clock. That means I have another 45 minutes based on the interest levels. If you want me to walk through my entire blogs, I have two blogs released yesterday, one based on 1 month return based top funds, and another one is 1 year return based top funds. I am very happy to to walk through both the blocks if there is an interest level. I am willing to take any questions. If I can't answer it, because I am also an idiot like you, those answers can be found by yourself by the help of Google Mama, because I tend to learn based on needs. My goal is not to prove myself as an expert, rather use the limited time and resources and make maximum returns. So with this, I thank you for your patient listening and open the floor for question and answer. And maybe I have to unmute anybody if they cannot unmute themselves. Let's see. Is there a need for me to unmute anybody? Let me know. So whoever wants to talk, please go ahead. You have to unmute before you speak. Anybody speaking?
Yes, good morning, Natarajan. This is Satish Bhatia.
Hi, Satish. I know you.
It is a very, very interesting and very knowledge-adding session you have taken. Thanks for it. My question was, generally and in daily advertisement, we hear that you should invest in mutual fund for a long term. That means you must keep invested for longer period. The growth which has been shown monthly, yearly, can be achieved only when you opt out or encash and then reinvest. Is my understanding correct?
I would say answer is yes and no. Basically, we have to apply common sense. See, whenever we get a bit of information from the market, it comes with the misinformation, it comes with confusion. As long as we understand what it means, we are in a position to execute very well. For example, a fund like CPSC, it is doing so well year on year. So if you can stick to that investment for the last 3 years, and not only that, if you have added on a regular interval, it becomes a multi-bagger. It makes us rich. So that is the spirit of long-term investment and regular investment. But if you are investing like throwing a dart at the dartboard without understanding what you are doing, it may so happen that an investment that went very well for the one period, let's say 1 year, can wipe out all its gains and you may lose it. So best thing is to know what you're doing and why you're doing that. For example, I started investing in mutual funds only from last July. So when I entered the fray, the large and mid cap funds were waning in their performance. Small cap funds were doing much better, right? Then after January, small cap funds, reduce their ability to give returns. Now there is a two schools of thought here. Let's say you are a small cap fund investor and you have a faith that they will come back in their performance. Then you will lose out all your gains in the last 3 months. And maybe with the systemic investment plan, which gives you more units and hopefully by the end of the election, maybe there will be a revival of small cap investment. So in
Okay.
that case, your patience would pay off, right? Same case with the PSU based stocks. So you have to take a judgment call as to whether it is worth ignoring a short-term correction on particular fund types or not. So there is a two types of interpretation as to what you are saying. One is that you need to be invested on a long-term base and you should keep adding money. I agree with that. But how you do that is subject to interpretations. It is more of an art. It is more of a portfolio management strategy, and only through experience you will finalize it. But if it is confusing and if it is discouraging you from participating from mutual fund, then do what is advised for the most basic type of investor. Do systemic investment plan on good funds.
Okay.
Got it, no?
Okay.
So
Understood.
a small cap fund, even with the huge correction in the last 3 months, has given 40% return on an annual basis. There is nothing to cry, right? Now, going forward, will it come down to 20%? So there are two issues when it comes to mutual funds: buy, hold, and sell. The decision criteria are applicable for buy and sell. Hold is do nothing. So it is easy. So you need to have an approach as to how do you want to buy into funds and how do you want to sell into funds. So when you get a free advice in the marketplace, many of those advisors can be duds because they may be influenced by their need to sell or their opportunity to make commissions, etc. So you need to be careful. Unless you are getting an advice from a proven professional advisor, you can be misled by going for a free advice by just doing web search. Okay. Just to give an example, I have my own strategy for mutual fund buy and sell because I am a new investor. Therefore, I am in an opportunistic mode. My time to become more strategic will come maybe after 2 years as I accumulate more funds. Right now, therefore, it's more important that I generate more funds to invest more. Therefore, I have been very opportunistic, meaning I am dancing to the tunes of the market vagaries, actually buying and holding and selling mutual funds as if they are stocks at the risk of 15% short-term gain and some exit loads also. Because I was convinced that it is important for me to protect the gains I made in small cap funds until January against 20 to 30 to 40% loss, which may happen by the time election is over. This was my individual situation. Got it, no? And I have already stated that my investment style is momentum type, which is when a trend happens, it tends to continue until we get a confirmation that it is not. So what I have found is that mutual funds tend to do well until the trend continues. For example, small cap funds did very well last 1 year. So that trend continued for 1 year. For example, CPSE ETF did very well for last 3 years. So by sticking to that trend, we tend to do well. Therefore, my monthly return analysis, which I do every weekly basis at the weekend, helps me to understand which trends are breaking and which trends are continuing. Therefore, I continue to invest in mutual fund, but I change my portfolio allocation. For example, In the last 2 weeks, I have been investing purely on commodity mutual funds because they are giving returns like 7.83% on a monthly basis. But this investment is more as a replacement to my bank FD than an equity mutual fund. When it comes to equity mutual fund, I am looking for a confirmation as to the correction is over. What I have heard in the industry and media is that typically the fourth quarter results are a bit subdued in India, and this year it could be further subdued mainly because of the superior valuation that has gone into these scripts, which means there could be a risk. There is no guarantee. There could be a risk of further correction through April, especially on small caps and some mid caps. Therefore, I have taken a conscious decision at the risk of losing out certain gains until April end. This is my investment strategy. My advice to you is you come up with your own investment strategy, understand what you are doing and be at peace with what you are doing. And there will be always give and take. There is always uncertainty. There is always, rear view mirror clarity. So that's why I said in the beginning, it's half glass empty, half glass full. But if you are making 30% annual return with no clue and no understanding and no strategy, no tactics, you are in a good situation.
Yes.
Maybe you are in such a situation, then continue what you are doing. I hope I answered your question.
Yes. It made it very clear. Thank you.
Some of you who have been in the mutual funds longer than me, can you share your annual return as on financial year 23-24, if you have that data, just for me to appreciate how my peers have done in the mutual funds in the last 1 year or 2 years. If anybody have any data to share.
I will talk about. In fact, that is why this question came into my mind. I started systematic investment through UTI, a very small investment, 5,000 rupee every month while I was in job. Continuously, I did for 5 years, and at the end of 5 years, I found that I did not get anything. So it may be because the market was not suitable, but I decided that it is a bad investment, so I withdrew everything. This was in the month of 2009-10, I think. In the month 2009-10, year 2009-10, I decided to withdraw. Then I kept silent on mutual funds for quite some time. But then in 2015, again, I thought ki everyone is doing and making money. Why not I again started? So I started the same systematic plan with UTI again and invested. I kept on paying 5,000 rupee every month again. And today the fund value is double the value which I have invested in total. So in practically 9 years, I have been able to double the investment value, though this investment has been in steps. So every month I was paying 5,000. So today this fund value probably is about 5 lakh rupee or so. So that is why I thought practically in 9 years, if my money is getting doubled, this money double I could get in investing in maybe if I had invested in say recurring deposit in post office, I would have also made it double. So practically what I am finding, if you are not encashing the highs of mutual fund, probably at the end you don't gain much. That was my understanding. So that is why I asked you this question.
Thank you. I got clarity as to your context. I have some responses. First of all, I would say that one should approach mutual funds with certain investment return expectations, because that puts you in an active role. Therefore you will wonder what is happening. Am I doing right? Is there a better opportunity? All that happens because of that objective. So in your case, you are a bit of a passive investor because someone told you to put in that particular stock and you just went through a phase. Now, irrespective of what happened, let me talk about what is the market situation today. India has done extremely well in the last 3 years. Okay.
Mhm.
And it is likely to do equally well in the next 5 years.
Right.
Okay. Therefore, participating in mutual funds is a significant opportunity we should not ignore. Now, the data clearly says that if you are a very smart investor and you are able to go behind top 50 performers, you have an opportunity of 70% annual return. If you are an average investor, you don't know how to go behind top performers, even then you have an opportunity to hit 40% annual return. Okay.
Mhm.
Now, the purpose of my blog is to elevate your understanding, your expectation, and your ability to set those objectives and tune those techniques. Therefore, because I am doing it for myself, see, I am more interested in achieving a percentage return between 40 to 70% for the current market conditions. Okay, through next 1 year. So at least 50% is, so I am very greedy, you could say, or I am setting my agenda very high. I may or may not. But even if I set my agenda at 50% and if I achieve 30%, it doubles my money every 3 years. Okay. So it is, my answer is, your situation would have been because you did not pick the right mutual fund, or you did not have a way of switching to better funds, but you can learn and do that better going forward, is what I would say. And the blog I generate every week is a very useful instrument to improve your learning, your awareness, and your strategy and style. That is my promise. I agree it is very painful to read, but I am always available. I personally am still aiming 50% if the market conditions remain the same like last 2 years. Got it, no? And tomorrow I will sit down and put my performance for the last 9 months across all segments, because I am still in a learning curve. So I am not expecting to do as much as I am aiming, but it gives me a clear distinction as to where I am required to tune my approach. So such an information I will share only in my WhatsApp groups, because it's too personal to share in publicly. So those who are interested can join my main WhatsApp group, which I can post before the end into the chat section.
Okay, thank you.
Prakash Upadhya, please.
Yeah, hi.
Hi.
Really interesting session. The thing is, what do you suggest? Like, how many? See, there are 1,500 mutual fund, but on a safe side, like, how many is how many mutual funds are is better to be easily managed or things like that?
Yeah, I would say it is your ability to manage details and complexity. Different
Yeah.
people are different. If you notice, I am highly perked up, highly active and too much causing tension to the rest kind of a guy. Got it, no?
Yeah.
So I'm okay with the complexity details. I'm very comfortable to deal with the 25 mutual fund investments at a time. But some people say I don't want to go more than 5. Got it, no?
Yeah, yeah.
Now, irrespective of the number, if you read my weekly report, there is one thing I am making it very clear. What I do is I pick top 50 across all fund types based on last 1 month return.
Okay.
Having done that, I will also calculate the average of this top 50 across various timelines. Then I will go and highlight the returns which are higher than that average in each timeline. Having done this, finally, I will mark those rows which have above average returns in all timing categories from 1 month through 1 year. I'm ignoring 1 week because it's too short, as an indication of consistent superior performance behavior. Therefore, I feel very safe to stick on to those consistent performance funds as long as that performance remains. So now what happens is, let's say right now this week CPSE does not appear in my top 50.
Yes, yes.
Okay, got it. No?
Yeah.
So what it means that whatever investment I have made in CPSE so far, I will maintain, because it is still good in terms of various categories, various timelines. But I am not making a fresh investment right now until it returns to the top 50 as a risk measure, that if at all it doesn't return, my new investments are not jeopardized. So what I am doing is slightly opposite to SIP. The systemic investment plan says that you keep blindly investing once you've chosen the fund, irrespective of what happens, which is nothing wrong. It's just that it gives you a subdued average return. I am aiming to give better return, getting better return by using the concept of momentum, which I have leveraged very well in stock market scripts. Therefore, I am very confident that I will achieve 50% more than SIP return through my technique. But it is for me. I am not asking anybody to follow me.
Yeah.
Now, based on the 1 year return block I have given you at the end of, you can take top 50 of 1 year and look at all the timelines within top 50 and choose those 5 funds or 10 funds which have given better than average returns for each timeline. You can do manually or you can do in Excel. If you need an Excel, I will send it to you. Got it, no?
Yeah.
So it is possible with the data I have already given, you can choose top 5 or 10 funds in that one year based report. I would recommend that for you.
Now, this switching, like you said, 1 month return or 6 months return. Now, switching can be done within that period, even with exit load. Does it make worthwhile, or wait for 1 year, invest and wait for 1 year to escape?
It's a fair question. Let me illustrate with an example. Let us say you have been riding on CPSE.
Yeah.
You are not sure whether CPSE will come back to same level of performance because of superior valuations.
Yeah.
Okay. Let's say you had a ride with CPSE up to 110% annual return. In the last 3 weeks, it has reduced to, let's say, 101. It has lost 10%.
Yeah.
Okay. Now, for some reason, riding in the last 3 weeks cost you minus 10%. Now, if you had sold CPSE, you would have paid 15% tax, which is, or 10%, depending on how long you are holding. So your tax liability there is anywhere between 5 to 10%, I would say, the marginal tax liability. But because by not selling at all, it is 0%. Because selling now, you paid a 5% more. So I would say 5 to 10% extra. Plus, you might have had an exit load of whatever percent, maybe within 1% for the recent investments. So your impact is in somewhere between 6 to say 11%.
Correct.
If you find the risk of losing another 10 to 20% in the next 1 or 2 months, you would make a decision whether to, whether to protect the return so far.
ಯಾರು ಫೋನಲ್ಲಿ ತುಂಬಾ ದಿವಸ ಆಯ್ತು ನೀ ಮಾಡಿದೆ ಅಂತ ಹೇಳಿ.
Okay, I am back. Just to complete that answer, what I have done is I might have invested around 10 lakhs in the last 9 months. And so what I did was, for me, since I am a beginner here, it was important to protect my investments and the returns. So what I have done is I took a judgment call as to what is likely going to happen in the next 3 months until the elections are over and the new government is in place. What I felt was that it's very unlikely that small cap funds will not do well, and sectoral funds, whether it is PSU or banks, mainly banks than PSU, may not justify their current valuations. So what I did is I ended up evaluating each fund as to risk versus reward. If the risk was more than reward, I sold it. As a result, I sold 70% of my holdings. That is, out of 10 lakh, I sold 7 lakhs, simply because only 3 lakhs worth of investments had better return than risk chance. Because I had invested based on a momentum basis, I had more of sectoral funds and small cap funds and micro cap funds. I just got rid of them from a risk management perspective, because I didn't want to lose 20 to 30% more on them in the coming next 3 months until the new government is established. This is a judgment call. Only after 3 months, I will know whether I was right or wrong. But nothing to cry, because I have got my returns, and I am sitting on cash now. So if the market becomes conducive, I am sitting on 10 lakhs to pump in immediately. In fact, I had anticipated this correction since July last year. So what happened through January to March is exactly as per my anticipation. In fact, I am somehow believing that whatever correction we have seen is only 50% done. The rest may happen through April, May is my judgment call. I may be wrong. Got it, no? So after this correction is complete, which I'll get a confirmation either by first week of May or first week of June, I am planning to pump in another 20 lakhs by breaking certain FDs, meaning this correction is an opportunity for me to put more money into mutual funds, which I do by taking the money out of fixed deposit. So actually, I am being very aggressive on mutual funds, but the approach is I don't want to play while the correction is happening. I want to play after the corrections are done, give or take.
So in a nutshell,
This is
you
one-
have to say that considering the tax implication and the exit load, if the return is high, it's better to exit at that point of time, in case you want to exit. Correct?
No, it actually depends on the individual case. I cannot, and I am not qualified, or I am not permitted to tell you publicly what you are supposed to do.
And one more
On
thing
your
is,
investment decision.
one more thing is that you gave that links for NSE ETF, BSE ETF, and all. In that NSE ETF, I just opened the link and I see that most of the NSE ETFs have already reached the highest mark. You mean the NAV is equal to the maximum mark. So when considering the top 50 top 50 ETF, which is giving a return of say like 50-60% a year, entering this will continue to give that kind of return, or it will be it will be the over and above the 50 what is being shown there.
See, there is no higher value as to how much NAV can reach.
Yeah.
It's unlimited. Now, there is a famous statement that market behavior so far is no guarantee for the market behavior in future. Therefore, we need to have a way of weighing market behavior or a particular fund behavior or a particular script behavior so far versus in future. That can be done only with a level of understanding of all the influences.
Yeah.
For example, as if small cap funds they correct by 30%, they will do well after that.
Okay.
Got it, no?
Yeah.
But they will do well after maybe June, after the new government is in place. Got it, no? If you are talking about infrastructure funds, there are, always they will do well. Got it, no? Whatever is the higher valuation will get justified by increasing revenue and profits. That is a comfort zone. Now, the financial sector, banking sector, etc., there has been a feedback that the valuation may be a bit high, so the risk may be slightly more than return, at least for next short term. Got it, no? So this kind of clarities you get in the media. In my case, I get a business line. The Hindu business line is one such source where I collect all this information. In fact, I also see CNBC where they make certain statements, and whether they can be right or wrong, but definitely they don't have a wrong intention to mislead you. Got it, no?
Yeah.
So one of the statements that came in CNBC just in the couple of days back is this fourth quarter results could be a bit disappointing. So for me, that is a huge risk compared to someone like you who have made investments already and got appreciation. I'm just getting started. It's very important that I don't lose money in my initial stages because my ability to multiply will reduce. So I have been a bit more sensitive to the risk factors, whereas you don't need to be. Got it, no?
Yeah.
Now, looking at CPSE, last year it appreciated by 75%. You cannot say that it's over because this year it doubled again.
Yeah.
So you have to make the judgment call based on forward-looking statements and analysis and your own comfort thing. India, the power sector is is exploding. Through green energy. The need of the power is so much. There is, I would say, power sector story is not yet complete. It's not done. I won't be surprised if CPSE gives above 70% again next year.
Okay. Now, these statements or this blog, what you are making, it's all done at individual mutual you just check from various sources like money control and then you update, or it is somewhere it is available
No.
as a
See, money
set?
control data is not reliable when it comes to aggregation across funds. See, typically what happens is mutual funds need to send this data, right? In a quick manner. So, for example, by Friday, the market ends for that week. By
Yeah.
Saturday morning through batch process, all this data needs to reach the agency. I have found value research is more or less more accurate in terms
Okay.
of representing most recent data when I look at it on a Saturday morning. This week, because Friday was a holiday, I had
Yeah.
the benefit of picking the data by Friday evening because all batch processes would have done by Friday morning it's effective, right? So I had enough time to deal with it. So I did it one day earlier actually. Otherwise, I will always wait until Saturday morning. Now, value research gives this data in a systemic manner, either short term, which is up to 1 year, or long term, that is 2 years and beyond. I typically download short term data. I have to download 4 times. One for all equity funds, one for all hybrid funds, one for all debt funds, and one for all commodity funds. Then I join these 4 distinct Excel files into one big file.
Okay.
Then I sort it based
Okay.
on 1 month return or 1 year return, depending on whatever is my focus. So a lot of donkey work goes into that. And then I give only top 50 because nobody will read all 1,600.
Yeah, correct.
Then
So it. Hmm. The internet is unstable for that.
okay, I think I have some network issues today. I will just complete by saying that in my blog, I have given you enough information in terms
Yes,
of top 50. If you have the patience, you have an opportunity to choose what suits your investment decision. There is enough information.
sure. Thank you.
Sure. Any other question, please? Or a request? PPU is still there and had a question for me. I think he has dropped off. So we have 7 more minutes. If any of you feel that I should have a very detailed walkthrough of my weekly blog, I am willing to do it as a separate session. Let me just give me that feedback. Now, for those who are interested to join my main community group, I will provide that invite by going into WhatsApp and copying that link. So in the meantime, is there any questions to deal with?
I think actually yesterday I had requested for joining the group, but still I don't think I've been added yet.
Okay, maybe it is a question of me pressing approve. So let me do that. Anyway,
no, it has
I will
come.
send it.
It has come. It has come.
Okay, let me try to get that link. Can I get it easily? Oh,
No, I got it. There, it is there.
okay, no. For others also. No, but I'm on a laptop, so I don't know how to do this. From my phone, I don't know how to send it now. So I'm unable to send it right now. So people interested in this link, please personally contact me. I will ensure it that you will get it. I have given my contact information. Whoever needs it can contact me, please. Any other question to address, please? Sorry, I'm back now. Are there any questions to address? Any comments? Any feedbacks? Any priorities to address in upcoming sessions, please? So if there are no discussions required, can I end this session for everyone, please?
Yeah, it's okay. Thank you.
So
Thanks.
Thank you, everyone. Please write to me if you want very specific sessions, because I am very enthused to conduct as many sessions. At the best, I will do 2 sessions per month. At the worst, I will do 1 session per month. And I personally am interested in sectoral research, clarity of value chain in each sector, for which I need help from others because it's too much work. And other than that, I would like to get into a bit more details of fundamental analysis and technical analysis in upcoming sessions. I also want to touch upon portfolio management. That's all I have got to say. Thank you so much for your patience. How many people will attend this session is not important for me, because this session getting recorded and getting uploaded for anybody in future to revisit is the main purpose. So I appreciate your faith in me and your patience to listen to me. Thank you all. See you again next time.
Thank you, Nataraj.
Bye.
Bye.